Hello everyone, in this video I will introduce what is cash flow from assets, like how to calculate the cash flow from assets. And so think about what we learned in our finance part, not accounting part. And we know for a company, if we want to find out the value of the company, or for financial assets, if you want to calculate the price of the assets, which is usually the present value of those company or assets. And you need to know what's the cash flows. So for funds, it's very easy to project the future cash flows, especially for those fixed coupon rate bonds. You know when and how much the company will pay you as a debt holder. But for a company, it's hard. So think about you and your friends decide to start a new business, and you will invest $5,000 upfront. So you and your friends in total have 3,000, and you expect a 12% return. And you borrow 2,000 from the bank, and the annualized interest rate is 10%. Your income tax is 30% because you're, partnership. So the tax will be just your income tax. So if we draw a timeline of this company's cash flow, for the company's cash flow, you invest 5,000 upfront. Those are negative. Those are cash outflows. And you will receive at the first year, end of the first year, you will summarize all the cash inflows and outflows, and you have a net cash flow, which is the CF1. Second year, you have the second cash flow. Third year, you have the third cash flow. And you have this discount rate here. So first, we should know the discount rate for the company should be weighted average cost of capital. And in this case, here, the weight for debt is 2,000 divided by 5,000, because you borrow 2,000 from the bank, and the total capital you invest is 5,000, and times the return for the debt, or the interest rate for the debt, times the 1 minus 30%, because the tax is deductible. And plus, we do not have preferred stock, but we do have common equity, which is the money invested by you and your friends. In total is 3,000. We divide by 5,000, that's the weight for the equity, times the 12%, which is your expected return. So the average, the weighted average cost of capital, which is the interest rate here, is 10%. Then we need to estimate the cash flows for year 1, 2, 3. So this cash flows called the cash flow from assets. That is cash flow generated by your assets. So cash flow from assets, how should we calculate it? It's operating cash flow minus net capital spending minus changes in net working capital. So the net capital spending, that is cash outflows, that is used to purchase fixed assets. And the changes in net working capital is also a cash outflow that is used to increase current assets. So in the formula, it's the same stuff. Plus means cash inflows. So the operating cash flows are cash inflows. That is because of the operation, the firm generates cash inflows for the firm, minus that's cash outflows. So first, of course, we need to find out the operating cash flows. This is a measure of the amount of cash generated by the company's normal business operation. It doesn't account for cash windfalls. So what is cash windfalls? For example, if the firm sells some equity and generates some cash inflows, that is cash windfalls. It's not the company's normal business operation. Operating cash flow indicates whether the firm can generate sufficient positive cash flow to maintain and grow its operations. And sometimes, if the operating cash flow is not enough, it may require external financing. Operating cash flow equals to earnings before interest and taxes. Add back depreciation. Remember, the reason is that the depreciation, it's not a cash inflow or a cash outflow. It's an accounting number, and subtract the taxes. So here is the income statement. We've seen that in previous video. So operating cash flow equals to income EBIT add back depreciation minus tax. Because as we all know, the revenue is cash inflow. Cost of goods is cash outflow. Depreciation, however, is just an accounting number. There's no cash coming in or spent out. So we add the earnings before interest and taxes with depreciation. We can get the net cash flows. And of course, we have to pay tax. So we add depreciation minus taxes, that is operating cash flow. The second step, if we look at the formula, first we already have this operating cash flows. The next step, of course, find out the net capital spending. Net capital spending is the amount of money or cash that the firm spent to acquire fixed assets. So basically, net capital spending provides information regarding additions to its fixed assets. It's equal to ending net fixed assets minus beginning net fixed assets and add back depreciation. The reason is here, why we add back depreciation. So at the beginning of 2018, Madison Call has net fixed assets of 518,000. On May, it buy an equipment. The cost is 24,000. The depreciation is 10,000. Then the ending balance will be the beginning balance, add the new equipment, but should minus the depreciation. So it's 532,000. But the net capital spending actually is this number. This is the net capital spending. And the depreciation itself is just an accounting number. It's not cash inflow, not cash outflow. So we found out that this net capital spending equals to the ending balance minus the beginning balance and plus the depreciation. So here, let's find out the net capital spending for this OZ firm. So the ending balance of net fixed assets, remember 2007, that's the ending balance. 2006, that's the beginning balance. And then add the depreciation is on the income statement. So the net capital spending for this year is $130. And then the third step is find out the changes in net working capital. Net working capital equals to current assets minus current liability. So changes in net working capital, here BS means balance sheet. So the changes in net working capital equals to ending net working balance capital minus beginning net working capital. So example, here is the information for Madison Count. So at the end of 2017, the inventory is 0. And then at the end of 2018, the inventory is 10,000. So we found out the current assets increased by 10,000. The current liability does not change. We found out that at the end of 2017, net working capital is negative 5,000. And at the 2018, the net working capital is positive 5,000. So the change in net working capital is 10,000, which is caused by the increase of inventory. So basically means we spend some money to buy inventory. The inventory is a cash outflow. So the changes in net working capital is also a cash outflow. So here, step 3, we find out changes in net working capital. The net working capital in 2007 is the difference between those two numbers. And the net working capital in 2006 is the difference between those two numbers. And we found that the changes in net working capital is $330. So the cash flow from assets for this OZ form is the operating cash flow we get minus the net capital spending minus the changes in net working capital is $87. And here I will introduce one more thing. The cash flow identity equals to cash flow to creditors plus cash flow to shareholders. So basically the cash generated by assets should either goes to creditors or shareholders. I'm gonna stop here. I will introduce cash flow to creditors and cash flow to shareholders in next video. Thanks for watching.